Have you ever wondered what it takes to successfully raise money? I have worked with hundreds of capital campaigns across dozens of industries, and I'm here to share with you proven methods for raising money in record time and at the lowest cost, while also obtaining capital at the lowest price. My name is Carl Dakin, and welcome to Motivated Money. Hello, this is Carl Dakin with Motivated Money. This is where we talk about raising capital from people who are most likely to invest in your organization. And we get to a decision point or determination of who is most likely to invest by using the motivated money approach, where we break down different investor candidates into groups. We assess their motivation or their level of self-interest in making an investment by determining just what kind of benefits that they may get out of making an investment in your organization. And we have talked about in past episodes about who is most likely. We refer to these as stakeholders, people who get a benefit beyond a return on investment by making their resources available to you. And the way this works, very shortly before we dive into today's topic, which has to do with what is capital, is that when a person may get a benefit from the success of your organization without ever making an investment, then they're a stakeholder. Now, this commonly includes all the suppliers and vendors that sell products and services to your organization. It may be somebody to whom you pay taxes, whether that's employment taxes or personal property taxes or other types of taxes into your community at the federal, state, or local level. It may be a common cause that you have with a social group where you're helping the environment or you're helping a certain group of people, and the success of your business somehow mitigates that problem and you become partners in solving this social cause. It could be a local community group who wants their economy at the local level to thrive and be good for everybody so that the quality of life goes up in their community. And then you have your customers. These are the people who look to buy your product or service, and the use or consumption of that product or service makes their life better. All these people are stakeholders. They all stand to benefit from the success of your organization before they make an investment. And then when you come to them and you say, hey, I would like you to provide some of your resources to me, some of your capital to me, and I'm going to offer you some kind of rate of return on that, which is a common type of investment, whether it's interest or a share of future profits or future revenue, then this investor gets a twofer. They get the benefit of the common style investment, which is some kind of a payback over and above the dollar value of their investment. Then they get the benefits, which they get as a stakeholder that accrue to them without making an investment. And this combination gives these people two reasons to invest, where a common investor only has one. And because there's this higher level of benefit altogether, this gives them greater motivation. This is greater probability that you're going to push this person to a point where they view making an investment in your organization a critical step in fulfilling their own mission and achieving their own goals and attaining their own milestones. So the motivated money approach comes at this from a different perspective, in that we don't want to talk to everybody in the world. We don't have the time to talk to everybody in the world who might be a prospective investor candidate. And we need to be efficient with our time. We need to get in and out in conducting a capital campaign to make it work. And so we want to start with talking to those investor candidates who have the greatest motivation, the greatest self-interest in making that investment. And those are most commonly going to be stakeholders. So with that, though, today I wanted to talk to you about one of the core concepts in the motivated money approach to raising capital, and that is the definition of capital. Very commonly, entrepreneurs, when you say you're going to raise capital, they equate the word capital to cash or money. They don't consider anything else as being a capital resource, or thinking of it in terms of raising capital as anything other than raising cash. And I want to talk about that today. I want to kind of bring everybody into focus on that, because that actually can make raising capital harder than it needs to be. It can take up more time, more energy, or even put you in a position where it's impossible to raise capital, because the people who have the cash aren't going to invest in your company. They just don't have sufficient motivation. And in today's capital climate, where inflation is surging, interest rates are continuing to be increased, people are becoming more conservative, and we're seeing statistics of 5, 10, 15, 20 or more percent of investments in a particular market segment of the capital industry going down year over year from last year. We know that everybody is trying to figure out how they're going to survive this almost certain deep recession that we're going to be stepping into. And people who have the discretion to stand and wait and not invest until after the recession is over are going to stand down. They call it creating dry powder, a reference to having cash on hand available to invest, but no interest in investing at the moment, because the opportunities simply seem too spooky, too risky, too unstable for them to make an investment today. So what they're going to do is they're going to wait. Now, you still will find institutional investors, private equity funds, family offices, other sources of capital, where the managers of that money are required to put that money to work. And if they don't, then it's going to impact them and the fees they can earn, and it's going to cause concerns by the people whose money they're managing. But even with those people who still need to look at opportunities today, they're going to be more picky. They're going to set the bar higher, going to have greater criteria. They're going to go, well, I won't invest in a startup, and I won't invest even in a 3-year-old company unless it's been profitable for 1 year or 2 years or 3 years, where before they might have done it with only 6 months of profitability. Everything gets tighter, everything gets harder, money becomes more scarce. And as it becomes more scarce, it creates a cascade effect on everybody else who also is asking the question of, where's this money going to come from? So in the motivated money approach, by looking at people who are stakeholders, we may find that despite the cost of capital, despite the risks that are out there in the economy and in different market segments, that they need you to succeed in order for them to succeed. And if they view you in that perspective, that they need you, then they may make their resources available to you when no one else will. And but part of the problem that we're going to talk about today is that capital, if you think only of capital as cash, you're looking at it way too narrowly, and it's going to limit and restrict all the many options that you may have for raising capital when there's no need to do that. Capital, if you look it up in the dictionary, is defined as any asset that an organization may use to build and grow its operations. And any asset means people, equipment, buildings, intellectual property, your contacts or personal networks, even contracts that you may have for the sale of products or services, your customers, your social reputation, your brand. These are all assets that are out there that have value. And so part of what you need to ask yourself is, if I'm going to go out and raise money, what would I do with that money? If I had a blank check from an investor today, what would I buy with the money from that blank check? You get out your shopping list, you go back to your business plan, you look at all the resources you need to attain your next milestone, to move your company forward. And this becomes your recipe for success. These are the ingredients in your recipe of all the different things you're going to need. And if you had money, you would spend your money on these things. Well, This is a list that everybody should have because it basically should be already in your business plan. If you have to start from scratch today to ask yourself, what would I spend money on? You probably should take some time and go back to your business plan and update it and ask yourself those questions. Okay, if I had the money today, what do I spend it on? What's my priority and what I'm going to spend it on first? What's going to get me my most bang for the buck? What's going to move my company forward the most if I have only some of the money I need as opposed to all the money I need? What you will find is that in the motivated money approach to raising capital is that you're looking at all the different stakeholders who are going to benefit from the success of your organization. And it's possible that some of these stakeholders have the assets that you need. They're on your shopping list. And now you give some thought to the fact that, well, if they're going to benefit from the success of your organization, and they already may be more predisposed to make resources available to you, and they happen to have one of the resources that's on your shopping list, why don't you go directly to them and ask them if they would be willing to invest that resource? So instead of getting $100,000 of cash, would they lease you a building for a year with no rent? Would somebody come on to your operating team, your C-suite team, and take on a managerial position at a discount from their market value and take stock instead of cash, or take deferred compensation instead of cash? And we could go through the entire list of everything that you might have. And it becomes now a very simple but serious question, which is, can I go to this stakeholder? Do they have the resource I need? And if they do, can I strike a deal directly with them for that resource, whether I give them equity, whether I give them a rev share, whether I give them a promissory note, all the same things you would have done if you went to a common investor and were looking for cash. But in this case, I'm just going to go ahead and create a shortcut, cut out the middleman, i.e. the cash investor, and go directly to whoever it is going to sell me or provide to me that resource I need for my business. And if they are willing to do that, think of how much time you've saved. Instead of a Texas two-step dance where you move to the left and raise the cash, and then you move to the right and you spend that cash to buy the asset, you did a single step performance where you went directly to the capital asset you need, and you worked a deal with them where you gave up whatever you had available to bring an investor on board, and you got the resource you needed in the form you needed it, and you did not have to go through the extra process and steps along the way. Now, obviously, for this to work under the motivated money approach, there has to be stakeholders out there who have whatever it is you're looking for. And they have to be willing to give that up to you for whatever you can give them in an offering and putting that together. But the likelihood of their willingness to make an investment is greater as the whole motivated money approach dictates. They stand to benefit from the success of your organization. This benefit may be monetary, non-monetary, it may be direct or indirect. But if they agree with you, if they accept and understand the benefits that accrue to them from the success of your organization, then by definition, they understand why it would be in their self-interest to provide a resource to you that you need. And of course, you've got to do all the other justifications to show your organization is going to succeed, that you've got a good management team, you've got a strategy for moving forward. All of those things don't go away. But now we're talking to someone who cares more about making the investment. And then to bring that home and to do it in the context of today's capital market, as I started off earlier in this podcast, right now, the capital market, particularly discretionary cash investors, are in a full retreat. They're walking backwards away from the market. And the market is too weird, too strange, too expensive. too unstable, and they are making good, rational decisions not to put their money at risk until they have a better idea of what that risk is going to be. And until the market settles out, which could be months, if not years, before we see a market get back to a point where we feel comfortable that we can reasonably predict the future, they're going to stand still. And those who set the bar higher are going to say, you still can't meet our bar. So if we talk about trying to compare apples to apples, which is a common investor to a motivated money stakeholder investor, we're going to find that in some cases, I can get the motivated money stakeholder to make an investment today because they still need to move forward. They still need you or see you as an asset in achieving what they want to do. Whereas a common investor is going, yeah, I could invest with you, but it's risky and I may get a rate of return, but I don't have to make an investment today. So I'm not going to do that. So it ends up, it's not apples to apples or oranges to oranges, it's apples to oranges. And whereas today in the current marketplace, there's no way for you to get a common investor to invest in your company on a rate of return, you still may have high success talking to your stakeholders and ask them for some kind of capital that you can get. And as I said, this can cover a range of things. You may find a city who has a building that the city or county owns, and they want to use that building to create economic activity within their area. And they're willing to lease that to you for $1 a month or some below market rate. And every dollar that you save there is $1 of common investment structure that you don't have to deal with. If you, as I mentioned, you can bring employees or advisors or anyone on who's going to help you today have use of them and their reputation and their services and their skills today without having to pay them anything or don't have to pay them full value today of their market value, then you have achieved an investment at this point in time. And this has put you forward because now you've got more resources than you had yesterday. And then we look at everything else on the list. If there's equipment out there that you need, can somebody has equipment sitting idle, let you use it for 6 months or a year because it's not being used anywhere else. And we could look at other things like networks. We could talk about all these other things that are forms of capital that a stakeholder may have. A stakeholder may step up and say, I'll endorse you to my entire network, which may be all their customers. This is actually very similar to a retailer going to their existing customer base and saying, we're bringing on a new product into our product line that we're buying from this vendor over here that's your organization, and telling all their customers they should buy it. Well, that happens every day. But a lot of people don't think about this as a way of raising capital. They think of it as a way of selling products. And it doesn't hurt, at least hopefully it doesn't hurt your head too much, to sit back and ask yourself, wow, that's actually a form of investment. Instead of me having to go out and sell each and every customer on a one-on-one and establishing a relationship and getting them to buy my products or services instead of somebody else, I work with a retailer. I sell to them at a wholesale price, or I sell to them on a fulfillment basis. But the net of it is they're out proclaiming and praising my products or services to everybody they know within their network, their existing and prospective customers. And you don't have to spend that money out of your pocket. They're making an investment, in effect, on your behalf by going out and selling as a retailer. And yes, you're giving up a portion of your price, a portion of your profits, but you don't have to come up with new cash in order to do that. And everybody you deal with, then, if you start thinking at it in this perspective, is a form of investment. Whether you're buying from a vendor and that vendor says, instead of having to pay cash up front before they deliver the product, they give you terms of 90 days or 180 days to pay that back. And if their interest rate, if they charge on that deferred payment is equal to or lower than the bank, then you're actually managing your money better. And if the bank won't loan you money, then we're back to the apples to oranges comparison, where you say, well, yeah, I need to borrow money from the bank, but the bank said no. That doesn't mean you cannot finance your purchases, but you need to work with the vendors and suppliers who give those to you. So all these things work together within the motivated money approach, where you'll find every relationship you're in may be a form of investment. And if it is, and the people you're talking to are stakeholders, then step back and ask yourself, what else can I do to make this relationship better, make it stronger, create more capital to you that you can use today in exchange for a price that you're willing to pay tomorrow, whether that is a higher price on the product, whether that is an interest rate for a deferred payment, whether it's a portion of the profits that come out of your organization. All these tools that you have in talking to a common investor are actually expanded with far more options if you're talking directly to a stakeholder who may provide you with those particular things that you need, those things that are on your shopping list. And this creates this new, larger source of capital resources. It's one of the phenomena that people really embrace when they get to thinking of raising capital from the motivated money approach. Instead of talking to a whole group of people who don't know you, who may not be qualified to make an investment or don't have any criteria, they're just kind of haphazardly throwing money at things. Or even if they come at this from a professional standpoint and they are trying to meet their investment criteria, you may not have a lot of options. You may not be able to make the rate of return. You may not be able to structure your deal so that your time cycle matches with the kind of investment cycle that people are looking for. And so at that point, using the common approach, raising capital, you're shut down. You have nowhere to go, and your business is going to do whatever it's going to do, and you're going to have to bootstrap yourself forward with the resources that are in your own hands. If you go to the motivated money approach and you now look at everyone as a potential investor who you work with for whatever reason, whatever any of the benefits are that can come out of the success of your operation, can you convert that in effect to your own form of currency? Can you create that benefit and exchange it for the resources you need so that you can keep growing and building your business even in these tough times, even during this great stress on the economy and this conservatism that is permeating throughout the capital industry? So in past podcasts, I have talked with entrepreneurs about how to design, stage, and manage their capital campaigns. And if you've listened to those podcasts in the past, and you'll see this in podcasts going forward, think about, where we start talking about structuring a deal that matches up with a stakeholder. And you will see that invariably on almost every occasion, there's one or several different ways to raise capital from a stakeholder that kind of vary from the norm, but still can result in you getting the resources that are needed, or that entrepreneur getting the resources they're looking for, without having calling the game and saying we have no way to proceed. And this is going to come up over and over again because you have a greater range of options. You can be more creative in how you put together your offerings. You can tailor your offerings to every different vendor, supplier, common cause, local government that's out there. So instead of a one-size-fits-all type of an offering, you may have 2, 5, 10, or 20 different unique offerings going to specific people, which addresses their needs and why they're there and why they're going to invest. And that gets to the heart of the deal, is that if you can talk to these stakeholders in their terms, you understand how you fit into their story, how you fit into their business plan, that puts you in a position where you may be able to negotiate for the kind of capital resources, capital assets that you're looking for. So for those of you who want to apply this to your own situation, want to do your own homework, take out a piece of paper. Of course, if you're modern, you could probably use your laptop, but we'll allow you to have your choice of writing utensils, and make a list of everything you need for your business today, everything that you don't have that you need to move forward. And this is your shopping list, whether you're going to the grocery store or the hardware store. You make a list and you put down everything on it that you need. Then make a list of your stakeholders, the people who are going to benefit from the success of your organization, and compare the two lists. Do you need a person who has particular skills with regulations with the FDA? Is there somebody who's a stakeholder out there who has that person with that skill? And is that something where they can loan you an employee, or they can sell you a service and take their fees later? Work through each of those matches that you find, and this will start giving you a framework for understanding that the shortest and most elegant and simplest and potentially far less costly way to raise capital is to go directly to the source of the capital item, rather than taking the longer route and talking to people about a common investment and trying to convince them that they should put their money at risk with you so you can take that money and walk over and buy the thing that we were just talking about. And so that is basically what the points I wanted to make for today's podcast on motivated money. Is that expand your horizons, expand your thinking, look at any form of capital that's out there. And then instead of thinking that the only way to obtain that capital is to write a check for it and pay for it in cash today, which you may have little or none to work with, think about all the stakeholders that are out there and what their willingness would be and how you might strike a deal with them to make this type of capital available to your organization, and talk to them about it, because technically you're talking strategically, you're talking partner talk, you're talking about working together for mutual benefit. And those people are always going to be open to having a conversation about how you can help them, even if it's going to help you. And whereas if you're talking to a common investor and you're saying, I need some money today, there may be no one to talk to. Or you can go through a number of conversations to get to the same unhappy result, which is, I'm sorry, we're not making any investments today. We've changed our investment criteria. I'm hearing these excuses day in and day out right now on different projects I'm working with. And I'm okay with that, because I know that I have an alternative way to go out and get capital for the projects I'm involved with, for the clients who I consult with, which is to go talk to the stakeholders and determine where we fit into their story and where we can help them succeed, which in turn makes them happy to talk to us about making resources available to us, because it's all in their own self-interest. Last but not least, before I finish today, as many of you know, I put on a boot camp on the motivated money approach to raising capital. We're actually in the fall session for 2022. We just completed session 8 and have a couple more sessions to go before the end of the year. But many of you are interested in learning more about this approach, about building your own capital campaign using the motivated money approach. And I will be putting on the next session of the Motivated Money Bootcamp starting on January 18th. If any of you are interested in participating, attending that particular boot camp, which will go on for 10 weeks, and it's been expanded to 30 hours from its original 20-hour format, then in that case, go to my website, motivated.money. That's http://motivated.money. And there'll be more information on that, or you can contact me directly, and I'll be happy to talk to you about the boot camp. and how you can continue to go out and raise capital even in the worst of economic conditions, because as much as you need resources in order to build and grow your business, so do other people. And these other people, if they're stakeholders and they believe that you can contribute to their success, then you have a chance to continue to raise capital when what you would consider most of the common and ordinary sources of funding are sitting on the sidelines for now. So that's it for today. This is Carl Dakin with the Motivated Money Podcast. Thank you for listening, and we'll talk to you soon.
Thank you for listening in to Motivated Money. If you like this or any other episodes, make sure to leave a rating and review the show. We love to hear your feedback and want to make this the best possible show for you. Also, if you like this episode, make sure you share it with someone you know who is seeking to raise capital. They will appreciate learning what you now know about raising funding. I'll see you on the next episode of Motivated Money.